We hail, we love.
Hello, my name is Dr. Abdul Adamu. This course is BUS217 Introduction to Finance. In this first study session, we are going to look at the overview of finance. So the learning outcome for this, at the end of this course, students should be able to define finance by different author, describe the different areas of finance, explain the scope of finance, discuss the functions of finance in an organization, analyze the primary and secondary objectives of finance, describe the different types of financial markets, describe financial instruments and how they are used to raise capital. The different definition provided by different author of finance are Braham and Ehardet define finance as the process, institutions, markets, and instruments that are involved in the transfer of money among individuals, businesses, and government. So we can see from this definition, finance involves the process, institutions, and markets, as well as the instruments. Beck and DeMazo define finance as the management of flows of money through an organization, whether it be a corporation, government, non-profit, or individual. So this definition is telling us that how organization, individual, corporation, and government manages their cash flow. The cash flow involves both the inflow and the outflow. According to Investopedia, finance is the science that describes the management, creation, and study of money, banking, credit, investment, assets, and liability. So, finance has so many areas depending on where we are looking at it from. But the three primary areas of finance are corporate finance, personal finance, public finance. For corporate finance is concerned with the management financial decisions that corporation make. So we have a business entity, corporation, their financial decision is what we refer to as corporate finance. Then for personal finance, it has to do with the financial decision of individuals. So at individual level, we have finance, the source for money, and utilize money. So that is personal finance. Public finance has to deal with financial decision of government and other public entities. So every year we see government present budget. This budget contains what they are going to utilize funds for and how they are going to generate those funds. So that is what we refer to as public finance. We have other areas of finance. They include behavioral finance. For behavioral finance, people's attitude, emotion affect the way they source and use funds. You can see some people have high risk appetite for business, for money, while other people are risk averse. This sum of behavior of people when they approach finance is what we call behavioral finance. Also, we have finance across national boundary, international finance, where you source for money or utilize money across national boundary. We term it international finance. In the scope of finance, they include financial planning, how firms plan their finance, how they utilize, how they forecast the use of the finance is what we call financial planning. Investment management, how they invest the finance. Then risk management, how they manage the risk in terms of the kind of investment they should be involved in, the kind of risk they should take on. Then we have also capital budgeting, investing in assets that takes longer period of time. When a company builds factory, they are doing capital budgeting. Then financial analysis, analyzing the finance of a company to know the source they can use, or what they can spend their money on, or taking the uh, financials of a company and doing the analysis to know whether to invest in that company or not. It's what we term financial analysis. So even businesses also do that. Then the functions of finance are classified into 3 or 4. We have investment decision. Finance, it is the function of finance to make investment decision, whether to invest in an asset or not. They have to look at the benefit from that asset and compare it against the cost of that asset. Then we have financing decision. What source of finance should they use? Whether to use debt or equity. Debt is when you borrow money to finance operation, or equity when you get this money from the shareholders of the company, or you dilute the ownership. Then dividend decision, it is the function of finance also when company make profit, either to decide whether to pay dividend or to retain the profit, or whether to give the dividend as cash or to give it as stock. So these are the 3 major functions of finance. Other functions, we have the working capital management, how firm invest in asset and liability that they use within a year, that is not more than a year. Treasury management, then ethical and social responsibility, conducting financial activities in an ethical way. So finance objective. Finance has so many objectives. We have the primary and the secondary objective. The primary objective include profit maximization. There are people that believe that the primary aim of business, which is also aim of finance, is for the business to maximize profit, to make profit. So some argue that profit maximization as an objective of finance is vague, because there are different types of profit. We have profit after tax, profit before tax, economic profit, accounting profit. So the other school of thought is that the objective of finance is wealth maximization. That is, if an investor or somebody invests in a company, they want the value of their investment to magnify, to increase in value. So if you buy a share 20 naira at the beginning of the year, and at the end of the year the value of the share is 80 naira, then you have, the wealth is maximized. There is a significant capital appreciation. So this is better than the profit maximization in their view. The secondary objective are liquidity. The firm should be liquid enough to be able to meet their day-to-day operation. Then solvency, they should operate. They should operate in such a way that they will outlive the owners. They will be solvent. Any small issue will not lead to bankruptcy or dissolution. Also growth. The firm will continue to grow in size, to grow and expand to other places. Then risk management, you identify and manage the risk that is associated with finance, whether liquidity risk, credit risk, and other types of risk. Financial market. The financial market refers to the mechanism through which the buyers and sellers of financial assets or instruments such as stock, bonds, currency, and commodity come together to exchange this. So the market where that brings together buyers and sellers of financial assets is what we call financial market. They can be divided into the primary market and the secondary market. The primary market is normally the market where firms issue new security. to raise capital from the investor. So when firms do initial public offering, going to the market for the first time, they are accessing the primary market. If firms want to raise money again, they do public offer. They are also accessing the primary market. Then the secondary market, after the investor buy these shares or debt, they can sell it in the secondary market to other investors who want to sell or buy this asset. So like the stock exchange, the Nigeria Exchange Limited is an example of the stock market, of the secondary market. Then we have other classification. We can look at the financial market in terms of the capital market, that is capital market for raising long-term security. If firm want to sell stock or bond, it's accessing the capital market. It can be money market, that is for short-term, highly liquid debt security. So treasury bills and commercial paper are sold in the money market. It could be derivative market for trading financial contract like options and futures. Assets that derive their value from these contracts derive their value from other assets like stock, currencies, and um, other things. Then we have the foreign exchange market, the market for buying and selling of currencies of country. So the foreign exchange market can trade the Nigerian naira against the dollar, or the dollar against the yen. Then what are the financial instruments that are traded in the financial market? The financial instruments are the various types of assets that are traded. They are divided into many categories. Some of them are equities. Equities are shares or stock that represent ownership stake in a company. Then we have bonds, that is the security that represent loan to a company or government. Then derivative financial contract that derive their value from an underlying asset. It could also be commodities like precious metal, cocoa, agricultural products, oil and gas. They are also traded in the financial market. Then we have currencies, that is medium of exchange of different countries. Then we have real estate, land, building, and estate. Then we have mutual fund or exchange traded fund. So these are collective investment scheme. They pull money from multiple investors and they invest on their behalf. So thank you for listening. This is the end of this lecture.